Hello and welcome to the Pearl Planning 2021 Economic Update and Investment Outlook. I'm Melissa Joy, and I am so pleased to be joined by Alexa Kane and Melissa Fradenburg, both financial advisors here at Pearl Planning, along with myself. Today, we're going to take you all across the world of investing. We're going to tell you what happened last year and what to expect for this year. We have a lot to cover, but we want to be respectful of your time. So we might as well just dive right in. I'm going to start by sharing the screen and I'll kick us off. So here's our agenda, and while there's only 5 bullet points, as all of you know, having gone through and lived through the last year, there is a lot for us to cover. So we're going to be talking about post the election as it pertains to investing markets and the economy. And then COVID-19 is very intertwined with economic outlook, so we're going to be going there. And then pivoting to the K-shaped economy, which is the best way we know to explain the current economic environment, followed up by investment themes, especially on stocks. And then finally, just what to think about going forward, what to think about for 2021. So without further ado, I would make one note, which is if you do have questions, we would encourage you. We'd love to hear questions from our audience. And so please email those questions to me at melissa@pearlplan.com. I will give you a reminder at the end with my email address again. And we'll talk a little bit so that we give you time to email questions, but do not hesitate to let me know if questions come up during the conversation. So as always at Pearl Planning, we do lean on and leverage the equity analysis investment strategy group from Raymond James. And so just a quick reminder of who that group is. They have a really strong bench and team of investment analysts. We're so pleased that, when we need to think about COVID-19 as it impacts markets, that we have a public health expert who is informing us, a medical doctor. We know that when we think about Washington, that we have someone with a strong government background and lobbying background who can give us context about the inside kind of the inside line of an investment perspective there. So just a reminder kind of where our information is coming from, sources, and then we implement strategies within the context of the analysis of the overall Raymond James strategy. Okay, we're diving right into the election, which you would have thought had wrapped up by this point in time, and yet here we are still feeling the impact of an election that occurred a couple months ago, more than 2 months later. The thing that we have been focused on in the last couple weeks, in addition to obvious headlines, is that there appears to be 50 senators who are Republican, 50 senators who are Democrat. That leads to potentially a top Democrat plus independent that align with Democrats, I should say. And that potentially could mean that there could be a lot of split votes. And given that the executive office will be held by Democrats with Biden and Harris, then Kamala Harris will potentially be a tiebreaker vote that would give some shift of power toward Democrats from Republican control in the past. So that is relevant as we think about policy. So we've focused a lot on divided government, not knowing what would be occurring in the Georgia Senate runoffs. And now we know that both runoffs were decided for Democrats. And so, we'll have to see what context of policy comes out of that. But we will be looking more toward policy that would potentially favor Democrats. And I think the top priority, at least initially, will be COVID responses, but there may be some additional stimulus that comes up. We saw stimulus at the end of the year, which of course was relevant for many, as well as just other policies. So now at least we know who the major actors will be in the next legislative and executive session, and we'll be going from there. Now, you may be wondering, because especially during campaigns, there is often narratives about the implications of one party versus another. And what we do not know the future, And we never, this is not just about politics, this is about investing in markets in general. If you think that you can have a crystal ball on what will happen in investing, just use the last year as a way to dissuade yourself from feeling that level of confidence. But what we know historically is that stock markets do not trade within a political cycle. Stock markets don't look and say who's in office, thus this is the returns that I should have. Perhaps Republicans were harshly impacted because of stagflation during the Nixon administration, as well as 9/11 for George W. Bush. But if you add everything up, in fact, investing under only a Democrat would have stronger returns than investing under only a Republican administration. Both much better than if you just choose to stay in cash, because I know some people, when they feel uncertainty or discomfort with something that's known, feel less comfortable investing. And most importantly, if you remain invested in the S&P 500 throughout time, that is the best outcome. So think about that. You shouldn't pick and choose when you're an investor. And I think this goes back to one of my summary themes, which is focus on what you can control. And one of the things that you can control is your process as an investor, your decisions on how to save and how to invest. Those are things that should not be shifted with the winds of, what's happening externally, or at least we don't think they should be within our process. But history doesn't always repeat itself, but it often rhymes. And we really think it's important for you to reference the actual, returns. And we're not predicting super strong returns because Democrats are in office. We're just saying that there's very little correlation or ties to who's in charge and where the returns are. Meanwhile, looking at things in general, we had a huge synchronized worldwide recession that came through and just rolled through everything last year. The only kind of green spot in looking throughout the globe, and this is looking at the left-hand side of this chart, is in China, which was the first to kind of experience COVID. Also had the ability to have very authoritarian shutdowns and full control of society. People don't always trust the numbers coming out of China as well. And they had muted growth prior to COVID. But just generally, was huge hurdles to economic growth. And the result of that is in a record high in terms of the number of countries around the world that were experiencing recession. Due to that, there's synchronized policy attempting to kind of revive the world. And you can see the forecast for future GDP, which we tell you, don't always believe the forecast. It's difficult to predict the future, but the forecasts seem to be green. And that's looking at the chart on the right. So it looks like there's an anticipation that there will be a return to growth from very, disrupted, deep cuts to economies last year, but that's what we're expecting going forward. And the numbers still aren't in for 2020. So we'll be seeing those numbers for how things finally wrapped up for the year coming up. One of the reasons that we think that there may be general growth in the future is because around the globe, everywhere that there is, kind of strong monetary policy, there is synchronized just attempts to revive economies. So that comes with stimulus, that comes with monetary policy, that comes with low interest rates. Typically as well, when you have a super sharp divot or recession, you also get a sharp recovery. We saw that in the third and fourth quarter last year. And this is really historic in terms of how bad things got, and that results in a historic potential rebound as well. So there's big positive economic growth expected from the world's largest economies, and we'll just wait and see. But there's one other area that we think lends itself toward positive economic outlook, and Melissa is going to be diving deeper into that, Melissa Fradenburg, when we talk about COVID-19. But the narrative of where the US economic recovery is happening is very closely related to the outlook for where the pandemic is and the virus. And so you see that we had sharp recovery last year, and then we kind of had our second wave during the summer, so things just muddled throughout the summer, and then things shut down more sharply in the fall and coming into this winter where we are today. Here in Michigan today, there were announcements that restaurants will continue to remain closed into February, and so it's just a slow recovery. And yet, and Melissa's going to be talking about this further, we do have a vaccine now, so there is some more certainty about what may be rolling out through into the spring and summer. And so we think that there is the potential for more of a back to normal going forward. So if you look in the middle of the chart with the vertical line, you can see where we are right now. And looking forward, there seems to be some light at the end of the tunnel, which we hope will be a narrative that helps to explain where the economy may be going in 2021.
Yeah, and actually, if you want to go back to that slide real quick.
Yes, I'd love to.
So yeah, if you look in that area where we sort of flattened out, so we had some recovery as things opened up, and then we had, as things opened up, more cases, more deaths. So right now, to get us through the little dip in the middle there, so if you look right in the middle of the screen, that's why we just had some stimulus, and to kind of bridge us through that area. But if you look at that, especially towards the end, end of second quarter to third quarter of 2021, you see that line really just starts to kick up there. And the reason for that, on the next slide, the biggest reason for that is the vaccine. So really, that's when we're going to see that move again. We need a little stimulus to get us through because things are still closed, especially here in Michigan. And but hope is on the way, and people are starting to get vaccinated. The biggest part about this vaccine, and I know just in talking to people about whether they're going to get it, I've been hearing people saying, well, I get the flu shot, and I always get the flu, so I'm not sure if I'm going to get the COVID-19 vaccine. One of the most exciting things about this vaccine is the effectiveness. So if you look at the green bar there, that's at 95% effective. And if you compare it to the bottom, the seasonal flu vaccine is only 44% effective. So it is much different, just like COVID-19 is not the regular flu. This vaccine is not your seasonal flu vaccine. The other thing worth mentioning, I know, especially here in Michigan, as we're rolling out between the phases, that it's hard to get an appointment to get a vaccine. But we, as a country, the United States has secured over 1 billion doses. And so there is going to be enough for the entire population to get vaccinated. Right now, we're just dealing with the logistics of getting everybody vaccinated, which can be a little bit tough to roll out. So this is just kind of an estimation of the distribution. And again, every state can decide exactly, who they're going to distribute in what phase. But the general idea is that phase 1, which is where most of the country is getting their hospital and frontline workers vaccinated first. We have just moved on here this week in Michigan to get our 65 and older starting to get vaccinated. Again, I know personally that it's hard to get an appointment right now because I'm trying to get my mom signed up. I do have a friend that just scheduled an appointment for her dad on Friday. It's coming, it's happening. The doses are available, so just be patient. But if we look ahead to where do we feel we're going to be by the end of the year, on the next slide, I can show you one of the exciting things is the Olympics, right? So the Summer Olympics were pushed to this year, and they're going to be in Tokyo on July 23rd. And Raymond James really feels like this is going to be not only something exciting to look forward to because the Olympics, that's fun to watch, but really as an area of when we will see a return to normalcy based on the distribution of the vaccine. And so our estimations is by that date, by the opening ceremony, which by the way is only 189 days away from today. So I know it may seem far off, but it's not too far off. Our expectation is that we will have 75% of the population vaccinated. And if you look at the graph here on the left, what's most important to note is that would include the majority of the 65 and over and people that are at high risk. And in addition to our healthcare professionals and essential workers. And not only is that important because that means that we can open up a majority of our economy, but also because that category of those who are still not vaccinated at that point, that 25%, has an extremely low morbidity rate. So you're looking at 0.5%. So you're looking at healthy adults who, if they were to get COVID, would really have a really small chance of fatality. So that's the exciting news. The other exciting thing to point out on this slide here is, if you tuned into our economic update at the end of 2020, you may remember that the rate of people in the sentiment survey by Raymond James Investment Strategy was about 40 to 50% of people that would take the vaccine, and now it's up to 80%. So we really need people to want to get vaccinated and to receive the COVID-19 vaccine in order for this to work and our economy to open, and it is looking like that will happen. So the combination of how effective the vaccine is, people's willingness to take the vaccine, and the availability of 1 billion doses available here in the United States that will get both doses to those who want to get the vaccine, are all really the driving factors of our optimism for 2021. Now, the K-shaped economy. This one, if you've been on our economic updates before, I'm going to just review here. So with COVID, there's certain areas of the economy, mainly in the internet retail and healthcare sectors and technology, that actually did better as a result of COVID. So that's the top part of the K there. Then there's the part that really had a V-shaped recovery when the economy opened up. So that's going to be more of like food and staples retail, construction, healthcare, pharmaceuticals, and IT. And we have seen a nice recovery in some of those areas. The bottom part of the K, though, is really what's going to be impacted the most by this vaccine. So once the vaccine, again, reaches that distribution and we can open up, areas such as airlines and transportation, hotels, specialty retail, and apparel, those are areas of the market that really haven't recovered. But once, again, this vaccine gets distributed, we do see that that area of the K will also recover. And even we've seen some upticks just with the announcement of the vaccine to the beginning of the distribution in the energy area. So there are certainly reasons to be optimistic. And again, we still feel this K really is the best way to describe the recovery and sort of how how the markets have handled this COVID-19. Now, in addition to the vaccine, these are some of the numbers that really give us reason to be optimistic about the economic rebound. 6.4 million jobs open right now, and we expect by the end of the year that unemployment will go to around 5%, possibly even below that, which when I was in school as an economics major, we learned that 5% is like the natural rate of unemployment. So that's very exciting news to really get back to that normalcy in that area. Housing is also very strong. With mortgage rates at 2.6%, that is the lowest 30-year fixed rate on record. So that really keeps the housing market moving. It enables people that haven't purchased homes to really be able to purchase a home, or for people to afford more home because of those low interest rates. So that's obviously a reason to be excited about that economic rebound. And then just the pent-up demand. If you have been out and about to stores like a Target or a Home Depot, and I have, because we moved, purchased a home during the pandemic, so there are certain things that I needed, like blinds for the windows, just to be good and neighborly, and they're impossible to find because the shelves are empty. So that idea that we need to rebuild the inventory and that sales are actually higher than the inventory available is another reason to be optimistic. And capital expenditures. So CEOs and business owners are saying they're going to increase spending this year by 29%, which is great news. And the number one part of that is going to help move our economy in this recovery is the consumer. Consumer spending makes up 70% of GDP. And so the good news here is savings rates doubled what the historic savings rate is. And there's 15.8 trillion in cash right now. And what do Americans like to do when they have cash on hand? Spend it, right? So 3.7% is the expected household increase in spending for 2021. And that means that the consumer is really going to drive this recovery. And if we look at what's going to drive it, it's going to be on services. So people have been buying things, goods, groceries. I know I have. That's probably my biggest expenditure right now. However, areas that have been hit the hardest in the service industry, such as restaurants, recreation, transportation, and accommodation, those areas are really going to be impacted by the economy opening up again. And in a survey, 67% of people surveyed by Raymond James Investment Strategy said they would feel comfortable going to a restaurant by the end of 2021, and 58% said they would feel comfortable getting on an airplane by the end of the year. So again, that's really where we see the economy opening up. And you talk about pent-up demand, in a national survey, 65% of people said they actually plan to travel more than they did pre-COVID, and 33% plan to spend more on travel when they do travel. So I know I've been eyeing, kind of fantasizing about future trips, looking at prices and figuring out, when it might be safe to do so. So I'm sure there are others out there who are also missing traveling and have that pent-up demand, which is all good news for our economy. And again, just talking about that timeline of when this is going to happen. So our estimates, or Raymond James Investment Strategy estimates, has it at the end of the second quarter, possibly the beginning of the third quarter of this year. And so if we look at that as when GDP is actually expected to recover to pre-pandemic levels, historically it takes about 18 months, and that would put us between 16 and 19 months. So that would get us to the recovery phase of GDP, which after that point, we're at the expansion phase, which is exciting because that's when we're going to see new highs and new growth there. That's just really something to look forward to, and driving that GDP. Again, looking at that recovery phase and going into the expansion phase in the late second quarter, early third quarter. And so with that, I am going to pass it on to Alexa to kind of talk about some of the specific areas of the market that we see as opportunities this year.
Yeah, so I'm going to cover probably 5 themes and thoughts we have for the markets in 2021. Our first area of opportunity we see is in municipal bonds. So if we're anticipating a tax increase, which Melissa will talk more on at a later section, that tax increase just gives us an increased opportunity in the municipal bond space. So that first chart shows the breakdown of individual versus corporation, their makeup of the total tax revenue. So if the government wants to increase the revenue, the logical place to do it is at the individual level, because it makes up about 85% of total tax revenue. And on that second chart, if we're looking at the municipal bond yields on there, if you look at the 10-year one, you can see that they're slightly below the treasury yield. But on the orange part, if we take into account the taxable equivalent yield, you're actually getting a much more attractive yield there. And if the tax rates increase, the attractiveness also increases for municipal bonds. So just something to keep an eye on there. Our next one is also about bonds, but it's high yield bonds, which actually act more like an equity. So what Raymond James is seeing and what is out there right now is the current yield for the high yield bonds is under 5%, which is a record low for that space. If we look at the third chart, the risk you're taking on to be invested in the high yield bonds is not rewarding you like it would if you were in the S&P or other areas of the equity market. So with the yield so low, we think it's best to let your bonds act as bonds and be your safety net, and use the risk or where you're trying to get the reward in the equities market, the S&P, and on that side. So just being mindful about what you're invested in. And talking on the S&P 500, we are optimistic for the performance going forward, but one thing we're having conversations about is being mindful of what to expect in the current environment. So March is going to be the 1-year anniversary of the bull market that we're currently in. And the first chart shows the first year of a bull market, the average return is about 40%. And when we look at that second year, that drops to about 13. And then 3 years out, it's still positive, but just barely. And as Melissa mentioned, we're at the end of that recovery portion and entering this expansion phase. So the returns are going to be there, the growth is going to be there, but it's going to be a bumpier ride and more volatility because we have gotten out of that phase. Our third chart just shows the ISM rating, and when the ISM rating is over 60, they do predict muted returns in the following 12 months. Right now, that rating is about 60.7, so that just means they're anticipating the muted returns and that the good news that's coming down the horizon, which the vaccine, places opening, all the things that we're anticipating coming up, they're already built into the market returns. So we do think it's going to be positive, but we just need to manage the expectations on what that growth will be. And where we are going to see this growth, we are very happy about cyclicals, and they're expecting 10 out of the 11 sectors to see positive earnings growth for 2021, led by industrials, consumer discretionary spending, materials. And if we take a look, small versus large value growth, you can see that all of them are expecting positive growth, just with a tilt to the small cap and the value side for 2021. And technology, we've seen definitely a large rise for technology in 2020. It was kind of forced on us, but it has been growing for quite some time, and we think it's going to continue to grow. The earnings per share growth from 2009 going to 2022, it's expected to be 232% higher than the S&P 500. They're also beating the quarterly expectations pretty substantially relative to the S&P and other sectors. And then on a business and corporation level, we've seen an increase in spending for the companies, and 90% of CEOs and business owners plan to increase spending in the future years. So it makes sense because everybody needs Zoom and everybody has adapted to this new way of working. And I think even when we're able to go back to some of our old ways, a lot of people will continue to use this new technology and embrace what it's provided for us. And then the technology, the revolution there has really impacted some of the other areas that we've talked about earlier. The industrials, we've seen a huge increase in robotics, the 3D printing, the drones, all of that. The consumer discretion space, 80% of people are planning to increase online spending for 2021. So if you think about how much online spending you did in 2020, and if you're like me, it was a lot, and 80% of people are planning for more in 2021. So our food delivery apps, all of that stuff, we've really embraced these changes and are not going to turn away from what it's given us. On the communication services side, we had Disney Plus come about, and they were targeting 60 to 90 million subscribers by 2024. And at the end of 2020, they hit 74 million. And with the 5G expansion, more video and streaming services and capabilities, they're going to just continue growing that. And then on the healthcare side, 83% of people are planning to still use telehealth, even when we are able to go back to our old normal. So the things that came about, they're not going away, and they're just going to continue to grow and expand. And we've seen it, and I think it really was embraced by everybody, and I think it will be exciting going forward what comes about from this. And then my last theme or topic for 2021 is on ESG investing, so environmental, social, and corporate governance investing. And this space has been around for decades, but I think the spotlight is kind of coming on to this space more recently. We're seeing the climate change initiatives for the Biden administration. We're having the impacts from COVID. We're also having the social justice issues coming more to the forefront and on the top of people's minds. So I was reading the other day that 1 out of every $3 that's invested is invested under a ESG mandate. So if we look back a few years, that's a huge increase in just awareness and the market space that it does take up. And the slide just shows kind of 5 reasons why the momentum is so strong for ESG investing. The first one is the NASDAQ submitted a board member diversity proposal to the SEC, and that would require 1 female and 1 minority on the board. If that was today, 75% of the companies would not satisfy the criteria. If you're watching the news, Apple just made their big announcement today about the racial equality and social justice mandate coming forward. The Biden administration, he has a strong focus on ESG principles. Brian Deasy, he was the former social impact advisor for BlackRock. So he has that background in the ESG space. And on a global level, 126 countries are committed to decarbonize their economies, and they are expediting the timeline for doing that. And we're seeing strong indications that the US is going to declare an emissions reduction, which would make 60% of world GDP be acting under this initiative. And then the Fed has also made a note that climate change is a risk to financial stability. And then on the shareholder level, there's just been a lot more proposals and talks around ESG related topics coming to light. So there's a lot going on in that space. We're starting to see more tracking. There's going to be more accountability and just more conversations about ESG as a whole. So, well, before I pass it to you, Melissa, I just was going to say that if any of you are pro-planning clients and you have a desire to talk about or to get involved in ESG, we do have ESG portfolios for all of our models available. So I'll hand it over.
Thanks, Alexa. I appreciate it. And it's true, about $1 and $2 if pearl planning assets are invested in ESG aware strategies. So we do have incorporated those strategies when we see opportunities that there would not be a diminishment of returns, or at least it would appear going forward. So looking and kind of wrapping up, when we look at stocks around the world, there's a consensus that things appear to be expensive. That's not necessarily surprising after such a strong year, which was accompanied by such a dismal economic year, where investment returns, especially if you measure it with the S&P 500, north of 15%. In the US, though, continues to be kind of the best house in a bad neighborhood, where we have stronger earnings growth, and around the world, valuations still appear to be high. Their price to earnings for 2020, much higher than the average price to earnings in the past. One question many investors have: how does monetary policy impact these valuations? Because you have very low interest rates, you have not a lot of incentive to be a bond investor. And so is that really pushing more and more cash over to the stock side? And let me tell you, it will be difficult to get interest rates higher without inflation, because any kind of bump up in interest rates for any bond asset class is going to have hungry investors, institutional big money investors, looking to gobble up that yield. So in spite of expensive stocks, we're going to be looking for pockets where things are less expensive. So we've described to you that technology is kind of infiltrating all aspects of sectors. There are some unloved areas that are not as tech themed, weren't as well positioned in the pandemic, where perhaps we'll be able to find some value opportunities or some mispricing. Areas around the world that may look more attractive as well. One of them is emerging markets. So emerging market stocks and potentially bonds both look to have strong growth premiums, or also they're just cheaper than stocks. And this was the case before 2020. And it continues to appear to be the case. There's a really strong growth story occurring at the same time that the stocks have been hit and miss and relatively unloved over most of the last decade. So that is another theme that we really strongly consider. So looking and kind of pulling things together, we do think that potentially taxes could go higher, whether that's in this next year or over time, I don't know. I would have told you before the election that taxes would be going higher. I just don't know when. Same answer today. Although we know that there's a tax proposal with the Biden administration that would indicate if you were a higher earner that your tax, or an investor who owns more taxable investment assets, that your taxes may be likely to go higher. Now, how do we deal with this as financial planners? One, we're tax aware. When we make investment decisions that affect your taxes, we know the tax costs of those decisions, and we really work hard to minimize tax costs, make appropriate elections for cost basis, evaluate if there's different, kind of tax circumstances from year to year, evaluating those low tax years, whether we should kind of push some taxes into that year. If you have a high tax year, try to keep the tax footprint lower. So taxes may be out of your control, but you can control the strategies that you use in terms of how you invest and the decisions that you make. So we feel that we are positioned as good as you can be in order to deal with a changing environment. Honestly, that's what we do as financial planners is we take in the information that we have, or the probabilities or possibilities of the future, and then try to act with the most wisdom that we can in order to address those types of things. So it all goes back, when we make investment decisions, to asset allocation. I know there are a lot of fancy themes that are going on today. Initial public offerings are coming out that are through the roof. Bitcoin and digital currency is in the conversation. When I look at how people are successful as investors, it's not about them picking the get rich quick stock. It's about the things they can control. Their decisions on how much to invest, how much to save, the discipline to have a process on how they invest, not to be too concentrated. And so we're going to stick with those processes that really got us through 2020. I think it was an excellent test of your ability to be an investor and to make good financial decisions, because there was so much volatility and disruption. So we're going to maintain that we're going to work with you to find the right mix of stocks and bonds, put you into a mix that you can live with through a market cycle. And that includes a year like 2020, where you could have started the year with $100,000 and be in 3 months later and only have $70,000. How do you work through that? Well, that goes back to your decisions on risk and your decisions on asset allocation. And this is a good time to remind you, even though the stock prospects seem to be better than bond prospects, high quality fixed income, that's bonds, have a purpose in your investment portfolios because they do act as a relatively low cost insurance for you when things go down. They were the kind of leaders of returns during the worst months of the market last year. That is the case over time, has been in the past. And so when the stock market declines more than 10%, it's the bonds that really rise. They're the cream that rises to the top. And even though we have paltry yields and, it's a dream for a borrower if you're trying to refinance a mortgage, and just a disaster if you're a retiree trying to pay for, your retirement off of the yield of a portfolio, we still do see a purpose for having bonds in your portfolio. We don't have a crystal ball. We could not have predicted last January that we would all be sitting in different rooms, not having all been in the same room for the 12 months prior. And yet, we've adapted and dealt with it. But, it was a very, very volatile year for stocks. In fact, more than 100 days had bigger than 1% moves, and we do not have 365 trading days in the year. So that's a huge number. So we anticipate that volatility will go down. Why? It's not an election year. The political risk may be lower. Geopolitical risk, gosh, I have a difficulty knowing what geopolitical risk really is, but maybe a little bit higher. But then, big reduction in the uncertainty of COVID-19 as we have a vaccine rolling through nations. So perhaps there's less volatility. We love to remind people at a time like right now that you should look back in the last year and remind yourself how you felt in March. Remind yourself how you felt when you opened your 1231 statement, which for most of you was probably pretty darn good. And just keep in mind that investing over time is really a marathon. It's not a sprint. So stick with your discipline, stick with the things that you can control in order to make good decisions. So just a reminder for those of you that have stuck with us, that you can send questions to me at melissa@pearlplan.com. In just a moment, I'm going to check my email and see if anybody had any specific questions for us. In the meantime, just a reminder, again, rebalance, make sure that your mix of stocks and bonds you're not over your skis, to use a winter term, in terms of where you're at with risk today. And don't get too cute. Stick to the, discipline of financial planning. Just make better financial decisions over time. Make decisions instead of having things passively kind of happen to you. And as I'm looking for questions, Melissa, can you just mention
Sure.
the action steps?
Yeah, Melissa's going to look over the questions. Here's some things you can do this year to kind of get you on track for the year. One is we offer a financial calendar for the year with tips on different financial planning areas that you can tackle kind of in bite-sized pieces as the months go on, important reminders such as tax deadlines. And there's also a great area in there that shows contribution levels to various plans and such this year that you can download on our website, pearlplan.com, for free. You can also on our website schedule a call if you have questions that you don't feel comfortable asking on a webinar and you would like to talk about your specific goals. You can also follow us on social media. We are on Facebook and Twitter. And you can also join our newsletter, which will send to your email any updates on future webinars and events, as well as share our market outlook. So do go to our website and sign up for those. Melissa, do you have any questions?
No questions so far. But if anybody has follow-up questions, you can also reach out to us via email or phone. Alexa and I both work in our Dexter office here in Washtenaw County, and Melissa Fradenburg is in our Grosse Pointe office. And we are always happy to answer questions, be a resource, and really provide perspective. As things change, just like we had this recent stimulus and we're communicating about that, don't hesitate to sign up for our newsletter. If you go to pearlplan.com, you'll be able to sign up for the newsletter or follow us on social media, Facebook and LinkedIn. We're always trying to communicate proactively to our communities as well as clients about what's going on out there. And with that, I don't see any questions, but we really appreciate everyone listening in to what we had to say. We'll keep you posted throughout the year and continue with these quarterly investment commentaries, and we'll communicate more if the situations require it with more volatility or news. So thank you for being a part of our community. And Melissa and Alexa, thank you so much. I loved what you had to say today.
Thank you.